Welcome to the Explainer. So let's just jump right in, shall we? Today, we're going on a bit of an analytical journey. We really want to figure out if a major player in the healthcare space, Surgery Partners, is a hidden gem or, a classic value trap. We're going to put this company through the ultimate stress test by looking at it through the exact frameworks used by some legendary financial gurus.
So here is the big question driving our analysis today. Is this massive healthcare target, which, by the way, has been in the news lately for a rumored $4.3 billion buyout, actually undervalued at its current market price? The stock ticker is SGRY, and it's trading right around $16 a share. To find its true intrinsic value, we're going to apply the legendary Wall Street models of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we'll run our very own quantitative valuations to see what the math says.
Okay, here's our roadmap for the Explainer. 1. Company snapshot and financials. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. DCF and alternative valuation models. And finally, 6. Synthesis and final recommendation. Let's kick things off with Section 1, Company Snapshot and Financials. All right, so Surgery Partners, ticker SGRY, is a heavy hitter in the medical space. They operate over 180 short-stay surgical facilities, and right now, they're pivoting hard into high-acuity musculoskeletal procedures. We're talking orthopedics, total joint replacements, the big stuff. At roughly $16 a share, they just posted Q1 2026 revenue of $810.9 million. That's up 4.5% year over year. Plus, management just reaffirmed their full year 2026 adjusted EBITDA guidance of at least $530 million. Not too shabby, right?
Moving right along to Section 2, the Warren Buffett lens.
So, Warren Buffett absolutely loves a strong economic moat. And honestly, Surgery Partners definitely has the scale with its 180-plus facilities, add in a growing fleet of 73 surgical robots, and they're really locking in market share for complex, high-margin outpatient surgeries. Management is also super disciplined with their M&A strategy, but here's the catch for Buffett: earnings consistency. While their top-line revenue is growing, SGRY reported a net loss of $35.9 million in Q1 2026 alone, and that's right on the heels of a full-year net loss in 2025. And that brings us to a massive, glaring red flag for the Buffett framework: 4.3 times net debt to EBITDA. Look, Buffett demands manageable debt and a high return on equity, period. With total net debt sitting at a whopping 4.3 times EBITDA, which translates to over $3.6 billion in long-term debt, the downside risk is just way too high for the Oracle of Omaha. Plus, those higher interest rates we've been seeing, they've become a very real cash headwind for them lately. So the main takeaway here is this: Buffett relies heavily on calculating what he calls owner earnings to figure out a company's intrinsic value, complete with a safe margin of safety. But since Surgery Partners is operating at a net loss, trying to calculate traditional owner earnings means we literally have to guess and normalize future cash flow estimates instead of looking at historical consistency. Because of that mountain of debt and the total lack of positive net income, this stock completely fails Buffett's criteria at its current $16 price tag. He would absolutely stay on the sidelines. Let's shift gears to Section 3, the Peter Lynch lens. Now, under Peter Lynch's system, we'd probably categorize SGRYs somewhere between a stalwart and a fast grower. The company is actually showing really solid momentum, like 4.4% same-facility revenue growth in Q1, mostly driven by a 3.8% jump in revenue per case. And they are aggressively recruiting, adding 140 physicians just in Q1. They're also targeting $200 million annually for M&A capital deployment. Honestly, it's a super compelling growth story, totally fueled by big structural tailwinds in the ambulatory surgery center market. But here's where the Lynch story gets really interesting: insider confidence. Back in 2025, Surgery Partners outright rejected a roughly $3.2 billion acquisition offer from its largest shareholder, Bain Capital. Their reasoning? They said they had greater upside flying solo. And on top of that, recent reports are swirling that TPG and United Health are circling with an acquisition offer worth $4.3 billion. To put that in perspective, that's roughly $33 a share. This massive display of institutional interest perfectly checks Lynch's box for a compelling corporate story and a potential asset play. Now, mathematically, Lynch leans heavily on the PEG ratio. That's price to earnings divided by growth. But historically speaking, we literally can't calculate it for SGRY because of their negative earnings per share, negative 28 cents in Q1 to be exact. However, if we look at forward projections, the dynamic totally flips. If their expectation of roughly 10% EBITDA growth actually yields positive EPS down the road, it looks pretty favorable. So, given the intense institutional backing and demographic tailwinds, Lynch would probably assign a hold or maybe even a speculative buy based purely on this growth story, even with the balance sheet looking a bit ugly.
Okay, up next, Section 4, the Benjamin Graham lens. Let's walk through Graham's strict defensive investor checklist point by point. First, adequate size? Pass. They're projecting over $3.35 billion in revenue. Strong financial condition? Fail. That debt is just way too high. Earnings stability? Fail. Like we said, they're losing money right now. Dividend record? Fail. They don't pay one. Moderate P in price to book? Fail again, mostly because the PE is undefined. You see, Benjamin Graham has this unwavering demand for positive, rock-solid earnings history, and that just slams right into SGRY's current reality of a Q1 EPS of -28 cents. For a pure, deep value investor who absolutely needs historical stability and a wide margin of safety, Surgery Partners just does not make the cut.
And it gets worse when we actually try to run the math. If we try to calculate Graham's intrinsic value using his classic formula, the square root of 22.5 multiplied by EPS multiplied by book value per share, the formula literally breaks down because of that negative EPS. We would be forced to use made-up, normalized future estimates to even get a number, and that completely violates Graham's core defensive philosophy. A true Graham investor wouldn't touch this stock with a 10-foot pole at $16.
Let's move to Section 5, DCF and alternative valuation models.
All right, so we are going to base our discounted cash flow, or DCF, models directly on management's reaffirmed guidance. They are confidently expecting at least $530 million in adjusted EBITDA for 2026. That represents an organic growth of at least 4.2% over their normalized 2025 performance. So this gives us a really solid quantitative baseline to build our free cash flow projections. Okay, let's look at the explicit assumptions we're using to build this base case DCF. We're forecasting free cash flows out 5 years. We're applying a terminal growth rate of 2.5%, which fairly reflects the long-term growth of the surgical center market. And for our discount rate, or WACC, we're going with 8.5%. We bumped that up a bit to account for their heavy debt load. When we run all those numbers using normalized cash flows, it spits out an implied fair value of roughly $22 per share. Now, check out this sensitivity table. It perfectly shows how tweaking our discount rate and terminal growth impacts the intrinsic value. Look, even in a super conservative scenario, like a 9.5% WAC and a 2% growth rate, the value still sits around $18. And if they really knock it out of the park and we use a 7.5% WAC, the value jumps up to almost $28. So in almost every baseline scenario here, the hardcore quantitative math is telling us this stock is undervalued at $16. Let's also briefly touch on a few alternative models. A comparable PE analysis? Yeah, that doesn't work here because of the negative earnings. But if we pivot and use an enterprise value to EBITDA multiples approach, and we apply a pretty conservative 10 times multiple to their $530 million forward EBITDA, we actually generate a fair value of roughly $25 per share. Oh, and it's definitely worth noting that Wall Street analysts currently hold a consensus target of around $22.25. Finally, Section 6, synthesis and final recommendation. So let's pull all of this together into a summary dashboard. Old school value investors like Buffett and Graham, they're running away from this stock because of the high debt and negative earnings per share. But Peter Lynch's framework suggests a hold because the growth story and that massive institutional buyout interest are just too compelling to ignore. Meanwhile, our rigorous quantitative models, the DCF and EV/EBITDA, are screaming that there's substantial upside, yielding fair values between $22 and $25. That is a massive premium over today's $16 price tag. So what did this all mean for us? Well, Surgery Partners is executing beautifully on top-line growth and shifting to those highly profitable procedures, which makes it super attractive on a cash flow basis. But that mountain of debt, it makes things incredibly volatile. So I'll leave you with this provocative thought. Does SGRY's quantitative upside and that massive M&A buyout potential outweigh the strict qualitative balance sheet risks for your specific investment portfolio? It is a truly fascinating stock that perfectly illustrates the massive divide between pure value investing and forward-looking growth models. Thanks so much for exploring this complex explainer with me today.